On the evening of October 27, 2025, China's Ministry of Finance and the State Administration of Taxation jointly released a new regulation on gold taxation. The policy, which came into effect on November 1 and will remain in force until the end of 2027, has already sparked intense discussion across financial markets. This gold tax reform, as it's now widely known, introduces significant changes to how gold transactions are taxed in China. It's a move that analysts describe as both experimental and cautious, a reform that reflects fiscal pressure and strategic restraint at the same time. Under the new rule, the price of gold per gram could fluctuate by as much as 50 yuan, according to early projections. And while the government has framed the measure as a step toward better market regulation, many investors view it as a signal of the government's growing fiscal stress. For years, China's fiscal system has faced increasing strain. Revenue growth has slowed, and the government is now looking for new sources of taxation. Gold, a market of immense size and liquidity, has become a new frontier for revenue collection. The new regulation makes a key distinction between investment gold and non-investment gold. Gold bars and coins are now classified differently from jewelry and industrial gold, each subject to separate tax treatments. Transactions conducted within official exchanges such as the Shanghai Gold Exchange will continue to be exempt from value-added tax, or VAT. But off-exchange, over-the-counter trades will now face a 13% VAT levy, a move that directly disadvantages small investors who rely on physical purchases through retail channels. Officials argue that the change is meant to encourage more trades through regulated platforms. By making over-the-counter transactions less favorable, the government hopes to push liquidity into institutional products such as gold ETFs and futures contracts. But for ordinary citizens who cannot trade directly within the Shanghai Gold Exchange, the result is straightforward: higher costs. Any additional tax burden on physical gold inevitably flows down the chain and lands on the final consumer. The policy also introduces a clearer distinction between taxed and untaxed transactions. Physical delivery of gold, that is, withdrawing it from storage, now triggers taxation. If no delivery is made, the transaction remains exempt. The line between taxable and non-taxable activity has never been sharper. Beyond the transaction rules, the new regulation introduces a layered tax structure based on usage. Gold used for investment is treated differently from gold used in jewelry or industrial production. Members of the exchange who buy standard gold for investment purposes can still enjoy VAT refunds and are exempted from certain surcharges such as the city maintenance and education fees. But if the gold is later converted into jewelry or used for industrial purposes, those tax benefits are lost. This granular classification system represents the government's effort to clearly separate gold's financial nature from its commodity nature. In policy terms, it marks an attempt to close long-standing loopholes that have allowed arbitrage between the two. The regulation also comes with new compliance expectations. Member companies must report the purpose of their gold withdrawals truthfully, with only one allowed modification within 6 months. Beyond that, no new invoices can be issued. Any company caught issuing fraudulent invoices or falsely claiming tax refunds will lose its eligibility for tax benefits altogether. It's a clear warning: the era of gray zone gold transactions in China is coming to an end. Analysts say this new framework strengthens regulatory control over the precious metals market, plugging loopholes that previously allowed traders to exploit the system for tax advantages. By tightening invoice rules and standardizing transaction documentation, the government aims to create a closed-loop system that leaves no room for manipulation. For jewelers and manufacturers who use gold in production, the regulation brings new paperwork and stricter audits. They can still apply for a 6% VAT invoice if they can prove legitimate use, but the verification process has become far more demanding. While the new policy does not introduce a new tax category, it indirectly raises costs across the supply chain. As raw material costs rise, jewelry manufacturers will inevitably pass those expenses on to consumers. Industry estimates suggest that jewelers' tax burdens will increase by around 6%, making retail price hikes virtually unavoidable. Gold jewelry could soon enter another round of price inflation, while investors purchasing bullion will face the steepest cost increase of all, full 13% VAT that cannot be deducted or refunded. The message behind this reform is clear: the government wants to collect more tax from investment gold, while channeling speculative capital into institutional markets. From a policy perspective, it's a move to secure revenue and regulate a fragmented market. But from a public standpoint, the reform feels far less friendly. Critics argue that the measure reflects desperation, a reform born of fiscal scarcity, as one economist put it, that undermines citizens' confidence in gold as a safe haven asset. In an era of growing US-China economic rivalry, gold has been increasingly viewed as both a private hedge and a form of financial sovereignty. Many believe that widespread private ownership of physical gold strengthens China's monetary independence. This reform, however, risks weakening that dynamic. To some, the timing of this policy sends the wrong signal. As fiscal and tax authorities seek greater revenue, the public perceives the government as competing with ordinary citizens for profit. Online, discussions are increasingly critical. Many accuse the state of taxing enthusiasm, of exploiting the gold buying boom for short-term gain. Others see the policy as opportunistic, a government taking its cut when citizens start making money. The sense of unfairness has become a recurring theme in public discourse. Yet despite criticism, enthusiasm for gold buying has not cooled. In fact, it continues to grow. China's long-standing cultural and financial trust in gold remains unshaken. Analysts note that if even 1 billion people each bought just 100 grams of gold, it would be enough to double global gold prices. Indeed, China's retail demand has become a major force shaping the global gold market. Even with domestic taxes increasing, international gold prices have remained strong, a reflection of the world's confidence in Chinese demand. Some experts predict that gold could reach as high as $5,000 per ounce within a year. Ironically, the very act of taxing gold may enhance its perceived scarcity and reinforce its role as a store of value. Observers have even drawn comparisons between gold's current trajectory and China's housing market during its boom years. Like real estate, gold now represents not just an asset, but a form of security, a personal hedge against uncertainty. And just like property, every new tax imposed only ends up being absorbed by consumers, passed along through higher prices rather than curbing demand. From a macroeconomic standpoint, China's gold market has effectively become the locomotive pulling global prices. The collective behavior of Chinese investors, from small savers to institutional players, is now a key driver of international trends. Experts argue that the center of gravity for global gold pricing is shifting eastward. The purchasing power of Chinese citizens is gradually reshaping the global financial order, especially in an age of volatility and geopolitical realignment. For millions of ordinary people, gold is more than a commodity. It has become a symbol of stability, a line of defense against inflation, financial uncertainty, and political risk. Policymakers hope that the new taxation system will create a more transparent and orderly market. But in their pursuit of control, they may be underestimating the role of trust. The stability of any financial system ultimately depends not on regulation alone, but on public confidence. When citizens feel that rules are designed against them rather than for them, compliance weakens, and economic vitality diminishes. Some economists warn that excessive restrictions on private investment could erode the domestic flow of wealth, what they call the internal circulation of capital. Limiting people's ability to invest in or hold gold could dampen economic resilience over time. As debates continue, more scholars are calling for a reassessment of the relationship between the state and its citizens in the context of wealth and trust. In a world of currency wars and shifting global power, they argue, gold should not be monopolized by institutions but should remain part of the people's financial foundation. To many Chinese families, buying gold isn't merely an investment decision, it's an act of faith, a personal safeguard against an uncertain future. History shows that when wealth is concentrated in the hands of the people, nations are stronger and more resilient. Limiting the flow of gold, on the other hand, may do the opposite, weakening trust and reducing the system's overall stability. In the end, this gold tax reform may prove to be more than a fiscal adjustment. It may become a litmus test, as some have called it, of the trust between the government and the public. Whatever the tax rate, whatever the policy's outcome, one truth remains: the glow of gold continues to reflect the hopes and anxieties of a nation. Gold's brilliance has always symbolized wealth, faith, and endurance. And even under new taxes, its light still shines not just on the markets, but in the hearts of millions who see in it something far greater than metal, a promise of security in uncertain times.